Welcome to the deep dive and a very special edition we're calling Bulls, Bears, and the Bell. Today, August 29, 2025, the market isn't just open. It feels like it's walking a tightrope. It's a fascinating and frankly pretty precarious situation. Okay, let's try and unpack this for you. We've got these two incredibly powerful, almost, elemental forces colliding right now. On one side, there's this sheer undeniable momentum of artificial intelligence. We're seeing AI-driven corporate earnings pushing the S&P 500 to fresh all-time record highs, a real show of strength from tech. But then on the other side, the entire financial world, I mean, from Tokyo to London to New York, is basically holding its breath for one crucial economic report. It hits the wires at 8:30 a.m. Eastern. The July Core Personal Consumption Expenditures, or PCE, price index.
Yeah, and what's truly fascinating here, it's not just the numbers, it's the sheer magnitude of the tension. We're really witnessing this pronounced state of what I'd almost call cognitive dissonance across the financial world. You have investors celebrating these remarkable micro-level successes, right? Companies like Snowflake, Pure Storage, their stocks are soaring. But at the exact same time, they're anticipating this macro level data point that could fundamentally challenge the very high valuations driving this whole rally. It's like the market is trying to hold two completely conflicting ideas in its head at once. It's quite something.
That's a powerful image, a market kind of at war with itself. So our mission today is to dive into these sources, help you understand what's really driving things right now, what's truly at stake with this big economic release, and also what surprising shifts we're seeing in company performance and global trends. So get ready, because this is going to be a deep dive into some serious insights. The central tension, AI momentum versus inflationary reality. Okay, let's kick off with that precarious intersection you just mentioned. The S&P 500 hitting record highs. You might look at that and think, fantastic, economy's booming. But the sources we've got today, they paint a much more nuanced picture, don't they?
Indeed. That record high, while it looked impressive on the surface, is largely, maybe almost entirely, a direct result of what our sources are calling blowout reports from a remarkably narrow group of stocks. We're talking high-growth technology and specifically AI-related companies. You mentioned Snowflake, Pure Storage, they posted stellar results. And these aren't just good numbers, they're critically confirming tangible financial benefits, real-world adoption from this massive AI investment cycle we've been seeing. So that creates this powerful but concentrated sense of robust corporate health, particularly just in that leading tech sector.
But you also use that phrase, holding its breath. So what is the big deal with this 8.30 AMET July Core PCE price index? Why is one single data point so absolutely pivotal today?
Well, this raises a really important question for everyone watching the market. The core PCE isn't just another inflation metric. It's actually the Federal Reserve's preferred measure. Why? Because it intentionally strips out those notoriously volatile food and energy components.
Right, the noisy parts.
Exactly. By doing that, it gives a much clearer signal of the underlying sort of persistent price pressures humming away in the economy. Now, the market. It has currently priced in an extremely high probability, something like a remarkable 88% of a Federal Reserve rate cut in September.
Wow, 88%, that's conviction.
It's huge conviction, and it's reflected right there in the Fed funds futures market. It's the collective bet by the big players. But this aggressive conviction, it's built squarely on one assumption, that inflation will keep heading down. So the PCE report today, it will either decisively validate that aggressive pricing, or conversely, it could trigger a sharp and potentially painful reassessment of the entire monetary policy outlook. It could send ripples through every asset class.
So it's not just about those fantastic individual company earnings. It's really about whether the broader macro environment can actually support those sky-high valuations we're seeing. And this is where that cognitive dissonance you mentioned earlier really comes into play, isn't it?
Exactly right. The market is simultaneously shearing these incredible earnings successes at the company level. I mean, some stocks soaring by double-digit percentages. While the dominant, overwhelming topic across all financial media, all analyst commentary, is this impending PCE data. Now think about this. A stronger than expected PCE reading, one that suggests inflation is proving stickier than hoped. Well, that would directly challenge that deeply ingrained narrative of imminent rate cuts.
Pull the rug out, potentially.
Potentially, yes. It would force a rapid repricing of Fed expectations, and importantly, it would disproportionately harm those very high-growth tech stocks that are currently leading the market higher. So while the current strength looks powerful, it's actually highly conditional and frankly quite fragile. It's like a high-stakes poker game. The Fed's next move isn't just about inflation, it's about managing market belief in their ability to steer this ship. The PCE isn't just a number, it's really a referendum on that belief. 2. Global pulse and key indicators. The world holds its breath.
Okay, it sounds like this tension isn't just confined to Wall Street. It's palpable across the globe, even before the U.S. markets officially open for the cash session. How is this playing out beyond our borders and, in other key market indicators?
Well, investor sentiment leading into the U.S. session is distinctly mixed, and I'd say cautious. It truly reflects that global markets' collective pause ahead of this pivotal U.S. inflation data. U.S. equity futures, for example, they're trading with a pretty subdued tone, pulling back slightly from the highs we saw after Thursday's close.
So the early excitement's worn off a bit.
Yeah, exactly. That initial euphoria from the strong tech earnings, the stuff that drove those S&P 500 records, it's largely giving way to these predated jitters. Futures for the S&P 500, NASDAQ 100, Dows, they're kind of fluctuating between small gains and losses. It shows a clear lack of directional conviction among traders right now.
Okay, a global pause then. How are Asia and Europe reacting to this impending data? What's the mood there?
Asian markets, well, they finished their sessions with mixed performance. Japan's Nikkei 225 edged lower, about 0.26%, and India's Sensex fell 0.87% on Thursday. Investors there grappling with the implications of those new U.S. tariffs that just kicked in.
The tariffs.
Right.
Yeah.
But on the other hand, Hong Kong's Hang Seng saw a modest rebound. It managed a gain of about 0.32%, and mainland Chinese shares actually posted a strong 1.14% gain. That seemed fueled by policy easing from Beijing and maybe some attractive valuations there. In Europe, we're seeing a similar cautious tone. Major indices like Germany's DAX are down around 0.63%. London's FTSE 100 slipped about 0.40%. And there's also ongoing political uncertainty in France, the prime minister calling a confidence vote over budget proposals. That's also contributing to a broader risk-off sentiment in the region. Basically, investors are preferring safer assets while things are uncertain.
It gives us a really good picture of the global mood. So what are the key market gauges telling us about how investors are actually positioned in all this?
Yeah, if we connect this to the bigger picture, we definitely see a landscape defined by watchful waiting. The CBOE volatility index, the VIX, often called the fear gauge, it actually fell slightly on Thursday to 14.43.
Lower VIX means less fear.
Well, less immediate anxiety, maybe, but it's still at a level that indicates traders are quite hedged against potential volatility. They're not complacent. The U.S. dollar index, the DXY, it's showing modest strength around 97.99, holding near its recent highs. That signals demand for the dollar as a safe haven, and a hotter inflation print would likely fuel a more significant rally for the dollar.
Makes sense.
And the yield on the benchmark 10-year U.S. Treasury note, it's holding steady around 4.23%. The bond market is also kind of in a holding pattern, waiting for this inflation data. Commodities are relatively quiet. Brent crude oil, gold, seeing minor losses. Natural gas is showing some strength, though, up about 1.43%. So all these indicators, they really reflect a market that is very much anticipating a significant move, one way or the other. It's like the market's trying to decide whether to put on its party hat or its hard hat today, all depending on that number at 8:30. A classic financial tightrope walk. 3, the macroeconomic showdown, PCE and consumer health.
Okay, the whole world seems to be holding its breath. But let's really drill down on the report that has everyone on edge, that core PCE data. What are the exact numbers we're watching for? And how precisely will the market react to each scenario?
Right, the specifics. The consensus forecast for the July core PCE price index calls for a month-over-month increase of 0.3% and year-over-year a rise of 2.9%. Now, to put that in context, this would actually represent a slight acceleration from the 2.8% year-over-year figure that was reported back in June, so not necessarily cooling further.
So 0.3 monthly, 2.9 yearly. Those are the magic numbers.
Those are the benchmarks. And crucially, the market's reaction today will hinge entirely on how the actual figures stack up against these expectations.
And what are those main scenarios we should be watching for? It sounds like we're heading for a pretty binary outcome here.
Yeah, you're right. It feels pretty stark. There are really 3 main paths, each with pretty distinct implications. First, an inline or maybe slightly hotter reading. So that means 0.3% month over month or 2.9% year over year. This would likely be seen as a net negative for markets.
Even if it's just in line.
Yeah, because it signals that inflation remains sticky, right? It's not decelerating further. That makes the Fed's job much harder. This outcome would challenge that narrative of imminent aggressive rate cuts. You'd likely see choppy, volatile trading, probably with a downward bias. Second scenario, hotter than expected. So greater than 0.3% month over month or greater than 2.9% year over year. This is arguably the most bearish scenario.
And a real worry.
The real worry. A significant upside surprise would severely undermine the market's conviction in that September rate cut, remember, the 88% probability. It could force a rapid repricing towards maybe a pause or even, in an extreme case, revive talk of another hike. This would almost certainly trigger a broad equity sell-off led by those rate-sensitive tech and growth stocks. Treasury yields would likely spike, and the U.S. dollar would rally strongly. And third, the cooler than expected scenario, less than 0.3% month over month or less than 2.9% year over year. This is the most bullish outcome.
The Goldilocks outcome, maybe.
Potentially, yes. A downside surprise would powerfully reinforce the disinflationary narrative. It would solidify expectations for September, maybe even open the door to a more dovish Fed stance through year-end. This would likely ignite a broad market rally with, significant outperformance in those high-growth tech stocks leading the charge.
Wow. So it really does come down to just a few decimal points potentially creating these massive market swings. But there are other data points coming out around the same time that add to the picture, right? These aren't happening totally in isolation.
Yes, absolutely. Also at 8:30 a.m. Eastern, released simultaneously with the PCE, we get personal income and spending for July. This gives us a crucial look at the health of the U.S. consumer, who's still the main engine of the economy. Personal spending is actually expected to have increased by 0.5% month over month, which would be a notable acceleration from June. So the consumer might still be spending.
Interesting. And then later.
Then, at 10:00 a.m. Eastern, we get the final August University of Michigan Consumer Sentiment Report. The preliminary number was pretty weak, actually, but the report's inflation expectations components will be really scrutinized.
What people think inflation will do.
Exactly, because the preliminary report showed a worrying little uptick in both one-year and long-run inflation expectations. The Fed watches those closely, too. So this combination of data, it presents a potential dilemma for the Federal Reserve. Think about a scenario with strong consumer spending alongside sticky PCE inflation.
Right, that sounds tricky. Stagflationary almost.
That's the word. It would signal a stagflationary environment, complicating the path for monetary policy significantly. The ideal Goldilocks scenario for the market, where everything lines up just right, would be a combination of cooling PCE data and moderately strong, but crucially not overheating, consumer spending. It's a very, very delicate balancing act. YV, stocks in the spotlight.
Right.
The bifurcated market.
Okay, so that's the grand chess match of macroeconomics and global sentiment. But down on the board, where the pieces are individual companies, wow, we're seeing a truly dramatic story unfold. A market really bifurcating right before our eyes. The sources are highlighting how winners are absolutely soaring while others are just getting punished severely.
It's stark, isn't it? This is where the rubber really meets the road. And yeah, we're seeing significant earnings-driven moves shaping the pre-market this morning.
Tell us about the AI winners leading the charge. Who's soaring and why? Give us the details.
Okay, on the gainer side, Snowflake, ticker SNOW, shares are just soaring over 18% in pre-market trading. They reported strong fiscal Q2 earnings, beat on both revenue and adjusted EPS estimates. And critically, they raised their full-year product revenue forecast. They specifically cited robust demand for their data analytics services, directly driven by AI adoption.
So proof the AI spending is real.
Tangible proof. Similarly, Pure Storage, PSTG, is exploding higher by over 31%. That's a huge move. It came after a strong beat and raise quarter, meaning they not only beat current estimates, but also raised their future outlook. Their rally is driven by powerful momentum in their FlashBlade product line and subscription services. They're positioning themselves as a critical enabler for high-performance AI workloads, and analysts are already scrambling to raise price targets on the stock. Bill Holdings, ticker Bill, also saw an 18% jump after reporting strong Q4 results, driven by healthy growth in its small and medium-sized business client base. So some real strength there.
So the AI narrative continues to deliver in a big way for those who can capitalize. But what about the other side of that coin, the companies experiencing these severe drops this morning? And here's where that cognitive dissonance we talked about really shows its teeth, right? Even seemingly strong results maybe can't escape the market's underlying jitters.
Exactly. The losers list provides a really crucial cautionary tale this morning. Take Accelerant Holdings, ARX. It's a tech-focused insurance platform, only IPO'd back in July 2025. It's plummeting by approximately 26%.
26%. Wow. despite good results.
That's the striking part. It comes despite the company reporting seemingly strong Q2 results, a 68% year-over-year revenue increase. This really suggests a classic sell the news event.
Meaning the good news was already baked in.
Completely baked in, it seems, and maybe a major valuation reset. The market had clearly priced in impossibly high expectations for this recent IPO. Then there's Newegg Commerce, Neji, the online electronics retailer. Shares are falling over 18%. This looks like a reversion to the mean for what has been kind of a meme stock. It had this absolutely parabolic rally, nearly 3,400% since early May. Just an incredibly steep climb, almost vertical, totally disconnected from its underlying fundamentals. Reality bites sometimes.
And any examples of those macroeconomic pressures like inflation or tariffs hitting companies directly in their earnings reports? It sounds like Hormel's a perfect example of that.
Absolutely. Hormel Foods, HRL, the big consumer staples giant, is trading down by more than 13%. They missed Q3 EPS estimates and issued weak guidance for the future. And management directly attributed some of the weakness to tariff-related pressures on its U.S. retail coffee division. That's a clear, direct example of how broader economic policy can instantly impact a company's bottom line. No escaping it. Finally, Cooper Companies, COO, a medical device maker, has plunged somewhere between 12% and 16%. They offered disappointing forward-looking guidance, cutting their full-year revenue forecast, even though they actually beat their quarterly earnings expectations. So the outlook matters hugely right now. V-corporate moves and global buzz.
Okay, beyond these big pre-market movers, what other significant corporate news and developments are influencing markets today? Stuff that gives us a wider view of the global business landscape.
Well, the global coffee industry, surprisingly, is seeing a massive shakeup. We've learned that Keurig Dr. Pepper and JDE Peet's have agreed on an $18 billion merger.
$18 billion. That's huge for coffee.
It's transformative. This deal creates a new global coffee co. with $16 billion in worldwide sales. It's positioned to directly challenge Nestlé's long-standing dominance in the packaged coffee market. It really signals a powerful trend toward consolidation in consumer beverages, a very bold move.
And on the flip side of that coffee coin, what's Coca-Cola up to?
Absolutely.
Sounds like they might be heading in the opposite direction entirely.
Yeah, in what could be a major strategy shift, the Coca-Cola Company is reportedly exploring a sale of its Costa Coffee chain. Remember, they acquired that for over $5 billion back in 2018. Coke has apparently engaged Lazard to review strategic options, and we're hearing private equity firms have already started submitting initial bids. A sale like that would mark a significant retreat from the hot beverage market for Coca-Cola. It would undoubtedly reshape the competitive landscape of global coffee retail, creating huge ripple effects.
Fascinating. Any other notable corporate headlines grabbing attention beyond the beverage world?
Honda Motor Co., HMC, announced a major long-term plan. They're relocating their global head office within Tokyo, but not until the end of 2029. It's a strategic move, they say, aiming to enhance productivity and foster innovation through a more collaborative one-floor office layout. Yamaha Motor Co. also announced some routine personnel changes. Those will become effective September 1st, 2025. So just some standard corporate housekeeping there.
We also saw some specific notes floating around about the Indian market, which seems particularly relevant given those new tariff discussions we mentioned earlier.
Yeah, for investors with exposure there, brokerage firms issued some fresh recommendations. We saw buy ratings for Maruti Suzuki India, Adani Ports and SEZ, and ICICI Bank. But from a technical perspective, India's benchmark Nifty index looks like it's at a critical juncture. Immediate support is identified in the 24,400 to 24,350 range, with key resistance up at 24,900. A failure to hold that support level could signal an acceleration of the recent decline, maybe down towards the 24,000, 23,800 area. And that risk is definitely amplified by those new U.S. tariff headwinds that could impact markets like India, so something to watch there.
6 analysts' closing take. Strategy for a data-driven session.
Okay, so pulling this all together, what does this all mean for today's trading session? Given everything we've unpacked this morning, the AI highs, the global jitters, and that absolutely pivotal PCE report looming, well, the narrative for today's session is, I think, unambiguously defined by this acute tension. You've got robust AI-driven corporate earnings on one side, and this pervasive macroeconomic uncertainty on the other. The market's position at these fragile record highs is being tested by a single pivotal data release. And the rally's leadership is currently very narrow, right? Concentrated in a handful of these high-flying tech stocks. That ultimately makes the broader indices highly vulnerable to any sudden negative shift in sentiment.
So a clear strategy for traders then, especially around that 8:30 a.m. Eastern window. It really sounds like we're heading for a decisive moment.
Absolutely. The trading strategy for the day really has to be bifurcated, meaning split in two, pivoting entirely on those 8:30 a.m. data releases. The period leading up to the data is likely to be characterized by cautious, probably low volume trading. You might even see some profit taking in those big pre-market gainers like Snowflake and Pure Storage as traders maybe look to reduce risk.
De-risking before the number. Makes sense.
Exactly. And conversely, those heavily beaten down names like Accelerant Holdings, they'll be searching for some kind of bottom. But post-PCE, however, expect a sharp and decisive market move. The direction will be entirely dictated by the data. A cooler than expected inflation print will likely validate the market's dovish Fed hopes and trigger a broad-based rally, but a hotter than expected print that will almost certainly spark a significant sell-off led by the very tech stocks that have been driving this market higher until now.
And which specific sectors should we be watching most closely as this unfolds? Where will the impact be most keenly felt, do you think?
Well, the sectors in focus today are pretty clear. First, technology and AI. They're highly sensitive to both interest rate expectations and that earnings momentum narrative. Second, consumer staples. We saw with Hormel, they're already showing the direct impact of tariffs and broader economic pressures. How resilient are they really? And finally, financials. They'll react swiftly to any shifting expectations for Federal Reserve policy. Ultimately, volatility feels like the only certainty today. The market, as it stands right now, it's priced for that Goldilocks outcome, cooling inflation that perfectly permits the Fed to start an easing cycle. Any data that deviates from that specific narrative will almost certainly be punished. Outro.
What an incredible setup this is shaping up to be. We've really seen the unbelievable power of AI to drive individual companies' success, push stock prices higher, but also the equally powerful and potentially disruptive influence of macro data like this core PCE report.
It's a classic push and pull, isn't it? Where the market is essentially priced for a very specific, almost perfect Goldilocks outcome. That scenario we talked about. Cooling inflation that lets the Fed begin easing. Any data that deviates from that narrative, even slightly, will likely see a swift and pretty decisive reaction.
So as you go about your day and perhaps follow the market's reaction to these pivotal reports, maybe consider this. How quickly can a market narrative shift from, euphoria to apprehension? And what does that tell us about the underlying stability or maybe the fragility of current valuations? In a world where micro-innovation and macro forces are constantly sort of battling it out, what does it truly mean to be well-informed in such a dynamic and interconnected environment?
Yeah, it really highlights the constant interplay between that corporate innovation at the micro level and these powerful economic forces at the macro level. It reminds us that no single factor operates in isolation in this complex global market. It's about seeing all the threads connecting everything.
A truly thought-provoking way to end our deep dive. Thank you for joining us for this Bulls, Bears, and the Bell edition, and we look forward to helping you uncover more insights next time.